Other thing to look out for is the biggest difference between commercial and residential is when you get a commercial listing, you generally don't have the typical 48-hour window you do with a single family home. Somebody tells you sell my house, list it, you sign the agreement, it's got to be up on the MLS very quickly. Commercial transaction, that doesn't happen. That's where pocket listings came from. You have a deal, I can shop the deal however I want because we're not regulated by the single family home MLS kind of police. There is no commercial MLS. They've tried to do one a couple of times. They've been fought almost every single time. And everybody knows LoopNet, Crexy, those sites are there. Those are going to be the only sites that are there because in the commercial world, you don't want everyone to know your business is up for sale, your building is up for sale. You don't want to share that with the general public a lot of times. So a lot of these things are done very discreetly. You'll notice if you're selling an apartment building, it'll be don't disturb the tenants, keep it quiet, hush hush. This is kind of the norm. And I think it's going to be that way for a while. So property and you're netting $100,000 a year. Now that's net, doesn't matter what kind of property it is. It could be retail building, office building, doesn't matter. Let's just say that's your net number, that's what you're working with. Whenever you're looking at a listing, unfortunately, brokers selling the listing do not help you obtain all the information. You're constantly having to call them. I mean, the marketing skills are terrible. You're constantly trying to figure out what's going on with this property. The bottom line is this is the main number you need to know. You have to know what the gross is. So let's say in this case the gross is $200,000. All right, so if the gross number is $200,000 and the NOI is 100, well, without even looking too much further, I can tell that's an apartment building because that's 50% expense ratio. So you figure out a property really quickly with 50% expense ratio. So if you have a buyer and they're looking for a 10% return on their money and they want to buy $1 million property, you already know this could work for them. Now, if you have numbers that with training and overlooking at so many deals, you kind of know these numbers don't make very much sense. It opens up a lot of questions. Could be anything. Could be they're self-managing. It could be maybe they're not reporting the taxes properly. Whenever someone else buys the property, taxes are changed, right? Property taxes change. So whatever the guy had 20 years ago is not going to be the new thing. So you got to do all new numbers. Now, if in this case, someone give me a good return on investment, throw a number at me. 8%. Okay. So let's say we're looking for 8%. Your buyer that's looking for an 8% return on their money, if they came to you and they said, hey, look, I've got $100,000, I'm looking for an 8% return on my money, you can pretty much work backwards, figure out what's going to work for them, and from then just look for properties that match in that category. So if you have a guy looking for an office building seems about right, you're probably going to get 8%. If you have a guy looking for an apartment building right now, you're probably not going to get 8%, right? Probably going to get a little less, probably around 6. So depending, the market dictates cap rates. Cap rates do not just come out of thin air. There's a reason they're there, and they come through a mixture of interest rates, they come through investor tolerance, how much money is out there in the marketplace. If there's not very much money in the marketplace and people have to pay cash for everything, this number goes up. So if you want an 8% return on your money, you would be looking at maybe office, warehouse. Maybe it would be very difficult to get it from certain deals. If you wanted, which is not really a risky investment, 8% is kind of average right now. So if you wanted a 6% return on your money, something a little more safe, a little more secured, you're probably buying something with a longer term lease, like a Wawa or a CVS or something like that, like a 10, 15, 20 year lease, depending on what it is. The lower the return, the safer the investment. So if you have like a Walmart in there and they've got a 20-year deal, you're gonna be okay. The problem is you have stunted growth. So you have a tenant in there 10, 15, 20 years, you can't raise the rent that much. You're only scaling it up 3% every year. you're going up real slow. Whereas if you have a shorter term lease, a couple years, get this guy out, new market rent. So it's a little riskier because the new buyer may not want to do all this work. If he wants an 8% return on his money, he knows he may have to get a little aggressive with the tenants there. Now, if you are